Hi guys, this is Investing with JYK, and today we'll discuss a little bit more about cyclical companies and industries. So, a viewer has responded to my video of UEC that I posted, I think, yesterday. Uh, so, I think he brings up a really good point in the sense that UEC looks like a horrible company from all the numbers. And so instead of explaining why I still like the company, I'm going to explain, I'm going to introduce the concept of cyclical companies and then how they behave in terms of price and profitability. So, what is, companies' profit changes um, from time to time. I think the Benjamin Graham called it the vicissitudes of the world. So there are most companies will follow the economic cycle. So in 2018, everybody suffered. In 2000 and in the 1970s, almost everybody suffered. 2010, there was a little bit of a small recession, so there was a general drop in earnings. So those are not. This is not the cycle that I'm not going to talk this in this video. If you're interested, I may make another video, but you can also check my video on LGIH, how that is going to be um, fairly strongly correlated to the economic cycle. But in this case, we're going to talk about cyclical companies that are not necessarily tied to the economic cycle. These are typically commodity producers. So the name commodity really means that there's no differentiation between the products. Oil is a commodity, which means my oil is the same as your oil. Instead of, let's say, compared to, let's say, a phone, a smartphone, Apple smartphone is different than Samsung smartphone, and Apple can sell their smartphone at $1,000. Samsung might sell them at 950 or whatever, and people might still want to put down that $50 more to get the iPhone. But in terms of oil, if I'm selling it at $10 and you're selling it at 9.5, nobody's going to buy it from me. So essentially, that means no individual company has pricing power in this industry. That leads to some fairly interesting phenomenon. For example, they quickly can get into this prisoner's dilemma kind of situation. So, for example, when oil is in oversupply in 2016, and it was like 3% oversupply, and the price just crashed from $100+ down to $20+. Now, the logical thing to do is for all the oil producing companies and countries to cut production to bring the thing into balance, and that's the idea behind OPEC. But then the shale people came up, and they're not under the OPEC control. So if OPEC tried to maintain the high price, the shale guys would just produce a lot more. So the only thing that they could do is just produce as much as possible to grab as much market share as possible. And as a result, that there's even more of a oversupply, which is why the price dropped so drastically. And if you look at this graph, this is the 30-year oil price. There are frequent bounces of, say, more than double. So you can see from here, you're looking at 1990. That's the Gulf War that went to 34. So that's more than a double. And then it dropped all the way back. So now you lost 60, 70%. From 1999 to 2000, you went from $10 to $32, and then that all went all the way up to $132, and very soon it just dropped again, more like 60-70%, and here is again a 60-70% drop. So these are very common, and the reason this one fluctuates so much is mainly tied to the production cycle. So price is just a signal for in the market for someone to produce. Now imagine if I want to produce more oil. What do I have to do? I have to first get some money, go to, get some people that knows how to explore for oil, buy some land that I think might contain oil, and then start drilling. I'll also have to get permit before I can start drilling, because there's all these environmental laws. And once I get the once all that is done, if I find oil, luckily, I need to then produce it, which means I have to buy equipments. These are large machines. They're not made in a week. They're probably made in like a month. Right? Then I have to set them up and start producing. And if I'm producing gas, I might even have to set up a pipeline and all that stuff. So all that may lead to like a year, 2 years, 3 years of lead time before the production can come online. Now, when price is high, say at 2011, right, at here, it's like, this is good price. If I explore for oil, and I find some oil, I should make a decent buck. If I can produce something at $60 a barrel, or even $80 a barrel, I sell it for 112, decent margin. So okay, let's find some oil here. So that's when that's when all the shale people started exploring and drilling, and as time goes on, they're like, oh, nice, let's produce some. So they start producing, and in here they've spent billions of dollars in aggregate, and now they want to massively produce, and that actually they started somewhere here. And this is when Saudi said, I'm not going to cut production, and this is when the price dropped like crazy. So all of them will at the same time, or at very similar times, start producing oil. And that outstripped the supply, then outstripped demand, and you get a surplus. So, well, you say, okay, but if you're losing money here, if your cost was 80 and you're losing money in here, why do you keep producing? The problem is you have the $80 may contain, $40 that was the drilling, the initial exploration cost. Another $40 might be the cash cost. So you may not want to stop producing just because you so that's one of the things where people refer to cash costs versus all-in sustaining cost. So cash cost is basically, if I keep the tap on, I keep pumping, how much does it cost me to pump each barrel? If it's $40, then as long as the price stay above 40, I can make some cash back. At least I can get some cash flow. Obviously, I'm depleting my asset, because these are depleting assets, and I'm depleting it at much lower price than I paid it for. So overall I'm losing money, but I can't afford to stop because I have debts to pay. I have all these cash flow obligations. So that's why people will keep producing, and that's why the business dilemma come from. So these are long lead times, capital intensive, so they have to borrow a lot of money to do it, So they don't really want to stop. They want to keep producing, and in order to make up the shortfall on the money, they will actually produce more. So as price drops, you will see the funny thing is that the existing producers, will end up producing more, not less. So they would actually deplete their asset faster at the down low instead of up high. So these are just very peculiar things that happen in these cyclical companies, industries even, and they have no pricing power. So their earning basically just follows this cycle. So we go from 2008 all the way to 2018. Let's take a look at what happened with a bunch of oil companies. Here is Continental Resources, this company in Oklahoma. Just keep your eye on the gross profit. So they were pretty low in 2008 because they were a very small company back then. But you can see there's a dip in 2016. All right, so this is BP. Remember the drop in 2009, right? So you can see the drop here, and then you can see the dip in 2016. Same goes for Exxon. Dip here and a dip here. And Exxon did not recover nearly as well as BP. And you can see Valero, exact same thing. So what does this tell us? This tells us no company in this business could get a sustaining steady income. Right? So how do we play around that? Now, if you look at the price for the first one that we looked at, the Continental Resources Inc., it basically just follows their profitability. And you can see when they were very small, they were fairly cheap, and in 2014 they kept on making more and more money, and the price was high, and in 2016 is the lowest. So when you should have bought is when they were least profitable. So these are fairly well-run companies. So this guy, even in 2016, they only lost $600 million. So, but if you look at quarterly, I bet some of the quarters might look pretty horrible. 2016, this is negative 90. You can see there are quarters where they lost $200 million, right? So, and then they went from basically $1 billion a quarter very quickly down to negative. And here is probably they cut some costs, whatever, and that just kept on declining until it went to 200 million. So when is this? That's 2016 March. When is the price the lowest? When you should have bought is 2016. So now you ask, how do I know the price can't drop lower? You don't. But there is one thing that keeps a bottom, basically provides a bottom for, not a bottom, but like a reference point that we can use for commodity prices. And by commodity prices, that simultaneously also means the share price for the cyclical companies, right? So that is the cost of the replacement cost, or production cost in this case. How much does it cost to produce a barrel of oil? Yes, as I said before, the producers might start producing more as the price drops, but they will exhaust their asset. Their deposit will disappear because you have to keep finding new ones. They have no money to look for new ones. Their deposit will disappear, and eventually the production will drop. It has to drop because you can't find anything more. You don't have anything more to pump. Right? So When does that happen? That means that happens when you don't have enough money to sustain the production. You don't have sustaining capital expenditure. And how long would that last? We don't know. But once the price drops below the production cost of the majority, or let's say 50% of the producers, or even in this case, oil is super sensitive to supply and demand balance because it's very difficult to store oil. It's a liquid; it actually goes bad, and uh, once it's out of the ground, you have to have special containers to keep them. It's very much not like, say, even things like, for example, gold. Gold isn't really sensitive to production because it's super dense, both in weight and in value, and it doesn't tarnish. So you can put it anywhere, and yeah, you have to guard it, but it doesn't go bad. It lasts forever, and you need a very small space to contain very high value. So that is usually not very sensitive to supply demand. But oil is the other hand. On the other side, a barrel is only, at the moment, $60. Right? So, and a barrel is really large, so you need a lot of space. So that is why oil is super sensitive. In this case, for oil, maybe you only need the marginal players to disappear. So if some of the shale guys die, or some badly managed companies or countries, in this case Venezuela, stops producing, oil supply demand balance will come back, and that's when the profitability will come back. So to summarize a little bit, is really the high price attracts capital. It attracts capital at approximately the same time because everybody sees the price. That capital gets deployed and finds new supply, so provides new supply. The new supply has a delay, so that's why the price does not immediately correct. It might even keep rising while the new supply is being built, and these new supply hit the market at approximately the same time, let's say within a single year, and you get an oversupply, and the price drops. As the price drops, they want to produce even more to cover for the shortfall on their cash flow. They have bank debts, so that makes exacerbates the down movement. So everybody starts losing money in the industry, or barely scraping by. And when the thing drops below the production cost, so cash cost in this case especially, it's just not sustainable. Even if it drops below all-in sustaining cost, over the long term, it's not sustainable. So all you now need to look is the demand side. Will the demand decrease? In the case of oil, they will not. In fact, they should increase, because as price dropped, we see the sale of SUVs pick up compared to sedans. Right? People buy less, fewer hybrid cars or electric cars. So in this case, the demand is not only assured, but actually increasing. While at the same time, the new supply after the initial peak will disappear because nobody's looking for new oil fields in that low price environment, and that will correct. And that happened somewhere here, and as the price increase, you get slightly more and more supply online. At the moment, you hear a lot of drawdowns on Oklahoma in Cushing, but don't take that too seriously. But the important thing is try to catch the bottom on these. You don't have to find this even. the you always need a reference point on what are the cheapest producers, right? If you buy there, you're typically not going to be too far off. Saudi can produce oil at something like, I thought it was something like $10-ish per barrel. The shale guys back in 2015 were producing oil at $80. As the price dropped, they tried to make themselves more lean. Technology progresses, so the cost of extraction actually goes down. Now they can be somewhat profitable at $50, $60. So, that's the thing. So when the price drops below 80, the shale guys before long they will stop producing. And when it dropped below somewhere here, in like the $60 area, it's starting to affect countries like Venezuela. And if, as you hear the news about Venezuela going to crap, you can be sure that these oil fields are not going to have the proper sustaining capital expenditure spent on them. So that will drive down production even lower. And by the time it reaches, if it reaches like $20 plus, even the Saudis were getting the squeeze on their financial situation. They were starting to borrow money. They issued their debt for almost like first time in like 20, 30 years or something. I don't remember exactly, but they issued some debt. Now, for a country that usually is just afloat in cash. And so those were all good signs, right? When the cheapest producer is facing some problems, these are the good signs. And I forgot when exactly that was, but if you bought oil companies back then, you made yourself a handsome profit. And so then at that point, OPEC came out and said, oh, we're gonna, cut productions to maintain the price, otherwise we're all going to crazy. So they are a big enough portion of the market. If they essentially collude against with each other, then they have the enough of a production. If they shrink it, they can bring the supply demand back into balance. And a bunch of US oil companies went bust during that time. So yeah, so that's my take on cyclical companies based on essentially just oil. These can be found in many other scenarios. For example, the mining industry, right? So this is tech, and when looking at this, when you should have bought is when they're losing money. I bet they were losing money at some point. Yes, you should have bought when they're losing money. Tech is a large player. Even the large players are losing money. Imagine the small miners. They will all be screwed. Same goes for BHP Billiton. This thing only has data for 2016, but you can see 2016 they lost money. That's when you should have bought. So for resource companies, if you know the company itself is a well-run company that's not going bust, you can always just buy it when even that, like one of the best-run companies, loses money. That's usually a good sign. It's very counterintuitive, but for these companies, you want to buy them when they are losing money, not when they're making a ton. And that is different if you are investing in small company that might have a real possibility of going bankrupt, in this case, the previous company that I talked about, UEC, that is a company that can really go bankrupt. Right? So if you buy that, you essentially have to predict how long they can survive. Can they survive for a year, 2 years, 3 years, maybe even 5 years? Right? So that's one important thing. Secondly, what are they doing on the down cycle? One, you should not be exhausting your deposit. UEC stopped mining uranium, so that's why I said it was a good decision. But if you stop mining, you have no income, no revenue. How are you going to sustain yourself? So you essentially burn cash. That's why I think these companies have very much like an option behavior to them. So these are higher cost, more marginal players. They're really more option like. They can go to zero. And the safe bet is you buy someone that is the lowest cost producer. They will gain quite a lot. So for example, tech, I'm sure tech did plenty well since 2016. Let's take a look. Oh, come on. Yes. See that? It's like $3. Now it's 30. And now the PE is really low. Before that, and here the PE is negative. Right? So does it mean this is going to crash? I'm not saying that. I think tech is still reasonably priced. The commodities they're producing are still not super expensive. But that's the power of being going against the cycle. If you go against the cycle in these companies, you should make money. And if you just look at Japanese BHP, even BHP should be behaving very similarly. Come on, what? I think this thing just went crazy. All right, BBL. BBL is another. Oh, I think their service just crashed. Never mind. We can actually see it here. So BHP, if you go to, I don't know, maybe summary? 2016-ish, there was at 25, now it's about 50. It's not as crazy as tech, but again, these companies buy them when they're losing money. When big players are losing money, buy them and sell them, and then don't buy them when the big players or everybody's making a lot of money, because that means more production will be online. I will go a bit more into cyclical companies in the future. Especially we'll approach it from the angle of capital expenditure and predicting demand. So I'll probably do one on Micron. I think that's surprisingly, even though it doesn't look like a resource company, it behaves very much similar to a resource company. And there is a very interesting story where Samsung behaved in a counter-cyclical way, and then basically they were now the dominant player. So as investors, we should also behave in a counter-cyclical way, and UEC behaved in very much a counter-cyclical way. That's why I really liked it. I don't like companies either selling or depleting their assets when the cycle is at the bottom. All right, thank you very much, and see you. Oh yeah, don't forget to subscribe, click like if you find this any useful. Also, I welcome any suggestions on what you'd like to hear. I'm also learning at the same time, so yeah, point out any flaws in my analysis, and I hope we all get value out of this.